Imagine you run a country that needs dollars. Not forever, just now. Imports, fuel, wheat, medicine, spare parts, many things are priced in USD, and debt payments have deadlines. So the country does what markets always do when they need cash fast. It offers a deal that is hard to ignore. Bring dollars in, we'll pay you a high return, and you can leave later. That's hot money. Hot money isn't good or evil. It's a financial tool, and like every tool, it has a cost. Today we explain only one concept: hot money, clearly with numbers. No politics, only mechanics. We'll cover 1. What hot money is, in one sentence. 2. How countries pay hot money returns. Discount paper, 80 to 90 paid today, 100 paid back later. Coupon bonds, interest payments, what coupon actually means. Combination deals, discount plus coupon. 3. Then we apply it to Egypt with a realistic illustration, 25% local yield. 4. Finally, why investors demand a high yield, why outflows can pressure the currency, and why hot money counts as government debt. 1. Definition: what hot money really is. Hot money is short-term capital that enters a country mainly to earn financial yield, not to build long-term projects. Short-term foreign capital chasing yield can exit quickly. Important distinction: FDI equals factories, hotels, long-term business, hard to exit quickly. Hot money equals financial instruments, easy to exit when fear rises. Hot money typically flows into treasury bills, T-bills, government bonds, bank deposits, money market instruments, and it reacts fast to interest rate changes, FX expectations, risk headlines, global rates, especially US rates. That's why it's hot. It moves fast. 2. The core idea. Hot money is always a two-part trade. This is the most important sentence in the whole episode. Hot money is not just an interest rate trade. It is an interest rate trade plus an FX trade at the same time. Meaning, you earn return in the local currency, but you care about profit in USD when you exit. So the investor's question is never only, how high is the yield? The investor's real question is, will the yield beat the FX move and the risks? 3. Return structure. Number 1. Discount paper, T-bills, zero coupon instruments. Discount paper is the simplest form. You do not receive interest payments. You receive profit because you buy the instrument below face value and get full face value at maturity. Buy below 100, receive 100 at maturity. 3.1. A simple example, 6 months. Face value, paid back later, 100. Price today, 90. Maturity, 6 months. You pay 90 today. You receive 100 in 6 months. Profit equals 10. Now people get confused because there are two ways to describe the return. A. Holding period return, how much you made on your money. HPY equals 100 minus 90 divided by 90 equals 11.11%. So in 6 months, your money grew by 11.11%. B. Annualized return, what it would be per year. If 6 months is half a year, a rough annualization is annualized approximately 11.11% times 2 equals 22.22%. This is why short-term bills can look very attractive. Even a small discount becomes a big annualized number. 3.2. Another example, 3 months. Face value, 100. Price, 95. Maturity, 3 months. Holding period return, 100 minus 95 divided by 95 equals 5.26%. Annualized, approximately. 4 quarters in a year, 5.26% times 4, approximately, equals 21.04%. Same story. Short time magnifies the annualized yield. 3.3. Why governments like discount paper? From the government side, it's easy to issue. It's short-term funding. It can be rolled over continuously. From the investor's side, it's liquid. It's short. It can be exited quickly unless FX liquidity becomes a problem, and that unless is the key. 4. Return structure number 2, coupon bonds, what coupon really means. Now the second return structure, coupon bonds. A coupon is simply the interest payment rate on the bond's face value. Coupon equals interest paid on face value. 4.1 example, 20% coupon bond, face value 100, coupon 20% per year. If paid annually, you receive 20 each year. At maturity, you receive the 100 principal back. So the bond pays 20 interest plus principal repayment at the end. 4.2. Coupon versus yield. Why people confuse this? Here's a key point. Coupon is not always the yield, because bonds can trade above or below face value. If you buy a bond at 100 and coupon is 20%, your yield is 20%. But if you buy it at 90 with the same coupon, your yield is higher. If you buy it at 110, your yield is lower. So investors look at yield, not just coupon. 4.3. Example, coupon bond bought at a discount. Face value, 100. Coupon, 20. Price paid, 90. Maturity, 1 year. Cash flows, interest, 20. Principal, 100. Total received, 120. Return on invested money, 120 minus 90 divided by 90 equals 33.33%. That's huge, because you got coupon and a price gain from 90 back to 100. However, 5. Return structure number 3, combination offers, discount plus coupon. When countries urgently need FX, they may offer a structure that pays in 2 ways. Discount at entry coupon during holding, sometimes short maturity. Discount plus coupon used to attract fast FX. 5.1. Combination example, simple. Face value, 100. Price, 92. Coupon, 10 for the year. Maturity, 1 year. Total received, 10 coupon plus 100 principal equals 110. Return, 110 minus 92 divided by 92 equals 19.57%. Now imagine the same structure but shorter maturity or higher coupon. The annualized return jumps again. 6. The bridge to FX. Why local return is not enough. Up to now, everything is local currency math. But hot money is a foreign investor game, so the real accounting is in USD. The investor does this mental calculation. USD, profit approximately equals local yield minus FX depreciation minus risk costs, where risk costs include liquidity risk, can I exit? Convertibility risk, can I buy USD at the end? Volatility risk, tail events, hedging cost, if available, political, legal surprises, rules changing. Even if you don't like those words, this is what pricing means. 7. Egypt example, 25% yield, step by step with scenarios. Now we apply it to Egypt as a clean illustration. Step 1. Investor brings USD. Investor brings $100 million. Step 2. Convert USD to EGP. Assume FX rate 1 USD equals 50 EGP. So investor receives 100 million times 50 equals 5 billion EGP equals 5.0 billion EGP. Step 3. Invest in local government paper at 25%. Assume local return is 25% for the year. After 1 year, 5.0 billion times 1.25 equals 6.25 billion Egyptian pounds. Now comes the entire game. Exit back to USD. 7.1. Exit scenarios. What happens when FX moves? Scenario A. FX stable. Best case, FX stays 50. 6.25 billion divided by 50 equals 125 million USD. Investor ends with $125 million plus 25% USD return. Scenario B. Mild depreciation. FX moves 50 to 55, 10% depreciation. 6.25 billion divided by 55 is approximately 113.64 million USD. Return approximately plus 13.64% USD. Scenario C. Break-even. FX move. Here's a simple rule. Break-even depreciation approximately local yield, roughly. If yield is 25%, a 25% depreciation can erase it. 50 to 62.5 is exactly plus 25%. 6.25 billion divided by 62.5 equals 100 million USD. Profit becomes zero. Scenario D. Larger depreciation loss. 50 to 76.25 billion divided by 70, approximately 89.29 million USD. Investor loses about minus 10.71% in USD terms. Conclusion. A high yield is not free money. It's compensation for FX and risk. 8. Why investors demand high yields in countries like Egypt. Investors demand high yield because they price a set of probabilities. A practical way to think of it: if local yield is 25%, investors may be thinking, expected annual depreciation, maybe 12 to 18%. Risk premium, maybe 5 to 10%. Liquidity exit friction, maybe 2 to 5%. So a 25% yield might be just enough to make the risk-adjusted return positive. Why high yields? Yield compensates FX risk, plus exit risk, plus volatility, plus uncertainty. It's not personal, it's math under uncertainty. 9. The biggest danger: synchronized outflows. Hot money is stable only while confidence is stable. If many investors exit at once, you get a chain reaction. Everyone wants USD now. USD demand spikes. FX weakens. Fear increases. More investors rush. More pressure. Central bank may use reserves. Reserves fall. To stop it, rates may rise. Debt service rises. Exit demand. FX pressure. Fear. More exits. Even if a country is fine long-term, short-term FX pressure can be brutal. However, 10. Why hot money counts as government debt. This part is simple and important. If hot money comes through T-bills and bonds, the government borrowed money. Borrowing means principal repayment is owed, interest is owed, refinancing, rollover, is needed. So yes, hot money invested in government paper is part of public debt. And because it's short-term, it increases rollover risk. You may need to refinance again and again, often at high rates, because the state owes principal plus interest. 11. One clean closing: what hot money really is. Hot money is fast dollars coming in, chasing high yield, and leaving when FX or risk turns. So the question is never, is hot money good? The question is, can the country earn enough stability and FX supply to manage the exit? Because hot money is easy to attract with high yields, but it is hard to keep when fear returns. That's hot money.